Today we will talk about the difference between systematic investment plan SIP and lump sum investing. So as an investor, we should use which option? Systematic investment plan has its own benefits and drawbacks, while lump sum investing also has its own set of advantages and disadvantages. So as an investor, we should use what? To answer this question, we have to first break down both of these investment styles, the SIP and the lump sum investing, into 7 heads. The first, we will try to understand what is SIP or what is lump sum investing. Then we will try to understand the benefits of SIP versus the benefits of lump sum investing. Then we will also unearth that for whom SIP is more suitable, for which kind of personality, for which kind of people SIP is more suitable, and for whom lump sum investing is more suitable. We will also understand that what is an ideal start time for initiating the SIP and what is the ideal time to start lump sum investing. We will also try to understand what is the ideal time horizon. It means for how much time the money should stay invested if we are doing a SIP or we are practicing lump sum investing. So finally, we will conclude by saying that which is better, SIP or lump sum investing. So first of all, what is SIP? Suppose you have initiated a recurring deposit in your bank. It means that every month a fixed amount of money goes towards the recurring deposit. So because a fixed amount of money is being debited from your account and it is getting transferred into a recurring deposit which eventually earns you some interest. So this form of recurring investing, where a fixed amount gets invested repeatedly over the months, this is called a systematic investing. And when we talk about SIP, this form of recurring investing, instead of going into a recurring deposit, it goes into a mutual fund. Now if we want to talk about lump sum investing, then in lump sum investing, as the name says, instead of investing gradually month by month, a big amount of money gets invested at a time. Suppose you are doing a recurring deposit of 5,000 rupees for 1 year. So at the end of the year, you will have 60,000 rupees parked in your recurring deposit. Suppose you are breaking that recurring deposit and all these 60,000 rupees you have used to invest in a stock. So in this case, every month the investment that you were making in a recurring deposit was systematic investing, and finally all that 60,000 rupees that you used to buy a stock, that was lump sum investing. Now let's look at the benefits of SIP. One of the primary benefits of SIP is automatic investing. You do nothing. You just give a bank mandate and every month a fixed amount of money on a fixed date will get invested in a mutual fund. The second benefit of SIP is low cost. Why low cost? Suppose you are somebody who is not able to save a lot from his monthly income. Means your savings is very low. So how you will invest? So mutual fund SIPs give you the option of investing just 500 rupees each month in the form of SIP. If your monthly savings is small, you can use the SIP route and invest just 500 rupees per month. You need not have a lot of money to start investing. One of the more notable benefits of SIP is rupee cost averaging. When the NAV of a mutual fund is low, you will buy more units, and when the NAV is high, you will buy less units. So this is what we want, no? Because when the NAV is low, it means that the NAV is better valued. So at a better value, you will want to buy more units. And when the NAV is expensive, when the NAV is very high, it means that it is expensive, and at those NAV levels you will like to buy less units of mutual funds. So this is what is achieved through SIP automatically. Suppose you are investing 2,000 rupees per month to buy a certain units in a mutual fund. Suppose the NAV is 10 rupees. So you will buy 20 units of the mutual fund. And suppose when the NAV has become 20, you will buy only 10 units of the mutual fund. So this is what is called rupee cost averaging. You are buying less when the NAV is high and you are buying more units when the NAV is low. What is the ideal start time for an SIP? Generally speaking, SIP should not be used to time the market. The mentality with which the SIP investors should invest is thinking that they should start the SIP today and they will continue buying the units of the mutual fund through the SIP for a very long time. So there is no need to time the market, but ideally speaking, if you really want to start the SIP on a right foot, you should see that the market is not bullish. When the market is only going up, up, and up, at that time, do not start your SIP. You should start the SIP when you see that the index is already on the decline. If the Sensex is going only up, 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 at that time, do not start the SIP. The best time to start the SIP is when the index has already started declining. So this is an ideal start point for an SIP, but it is very important to note that when you start a SIP, let it continue for a very, very long time. You cannot expect benefits of SIP if you are investing for a very short duration. There are very high chance that a short duration SIP will only lead to losses. So better is to spread your SIPs for a very long term time horizon. Now let's talk about lump sum investing. We have already seen what is lump sum investing. When you are investing large sums of money at one go, that is lump sum investing. So what is the benefit of lump sum investing? The main benefit of lump sum investing is it helps you to take maximum advantage by timing the market. Suppose on March 2020, when COVID just entered the world, at that time you must have noted that in March there was a massive crash in the stock market. Suppose at that time when the market has already crashed, when it is at its bottom, and you had some large sum of money in your savings account, in your fixed deposit. So if you had invested at that time, March 2020, those lump sum money into the stock market, your capital would have grown considerably today in 2023. So to get the maximum benefit of a stock market crash or a major correction, you have to have lump sum investing done. So this is the main benefit of lump sum investing. It helps you take advantage of the crash and major corrections. For whom this lump sum investing is suitable? For those investors who like SIP. Who are those investors? Those investors who are very busy, who do not have a lot of time to watch the market and to analyze what is the right time to enter and exit. For those kind of people, SIP is suitable. SIP is also suitable for those people who do not have big amounts of money to invest. They can only invest small amount. For them also, SIP is suitable. So for those kind of people who likes passive investing, who likes to invest money in a automatic mode, no hassle, every month a fixed amount of money should get invested, so if they prefer this kind of approach, for them SIP is more suitable. But for those people who are more involved investors, who wants to watch the market, who wants to analyze stocks, who wants to analyze mutual funds, so for these kind of investors who already are very aware of the market situations, for these kind of investors, lump sum investing is very suitable because it can generate very high returns for these kind of investors. But for sure, you will have to give a lot of time in reading and understanding the market. Not everybody has time to observe market so closely. So that's why most of the people invest through the SIP route, and lump sum investing not many people practice. The ideal start time for lump sum investing is for sure when the market is almost at its bottom. Investing lump sum amounts of money when the market is at its peak can be very, very dangerous. So for lump sum investors, it is necessary to have this know-how to judge if the market is at its bottom or at its peak. So even if the market is nearing its peak, it's better not to invest. If you have to invest lump sum amount of money, you should make sure that you are investing only near the market bottoms, and then only you will get benefits. Otherwise, either your returns will be too low or it will also show negative returns. So it is very important for lump sum investors to practice investing only at the market bottoms, when the market has crashed or it has seen a major correction. This is one of the risks of investing lump sum amounts of money, because if you are not able to judge the market properly, that whether it is at its bottom, then you can face losses. The ideal time horizon for lump sum investing is very similar. The money parked in SIP should stay invested for a very long time. Similarly, whether you have bought the units of mutual fund at the bottom or near its peak, it's very important to leave that money for a very long time. If you have bought mutual fund units at the market bottom and also you are allowing that money to stay invested for a very long time, in that case your returns will be extraordinary, market beating returns for sure. Suppose by mistake you invested a lump sum money at the market peak. Even then, don't worry, you will not face losses. Just make sure that you leave that money for a very long time, stay invested. And when I say very long time, both in case of SIP or in case of mutual fund, this time horizon is 5 years plus. You stay invested at least for 5 years. So if you're practicing SIP and lump sum investing, especially in equity market, the time horizon should be 5 years or more. Now finally, which is better? I will tell you what I do for myself. Majorly, I'm a stock investor. So I do my stock analysis and I invest kind of systematically in stocks and increase my holdings for the stocks. But here we are talking about mutual funds. So I also invest in mutual fund. What I do, that I practice both the strategies. First of all, I always keep some SIP on for all the time. I do not look at those SIP. I just pick up a good mutual fund and I keep investing in that mutual fund systematically every month. And I need not bother about that mutual fund, because whenever I start a SIP, I start with this mentality that this SIP is going to continue at least for next 10-15 years. Unless and until the mutual fund has gone bad, I will not stop that SIP. It will continue investing there. So one automatic form of investing is already in place. And the second part is, whenever there is a major correction in the market or there is a major crash seen in the market, I try to buy the units of the same mutual fund, that SIP mutual fund, at the market bottoms. So whenever I see that the NAV of my mutual fund has corrected by about 8-10%, I go ahead and put some lump sum money in that mutual fund. If I see a crash like what happened in 2008 or what happened in 2020, in those times I again I invest a larger amount of money at the market bottoms in the same SIP that I am running through. So this way I get advantage of both the SIP and lump sum investing. I hope you like this video about SIP versus lump sum investing. If you like this video, please give it a thumbs up and please do subscribe to my YouTube channel.